investing carries the day. This is my Philippine-focused fund versus all the UITFs in the market today. Since inception of 24th February 12 up to 24th February 15, 3 years of history, my fund, Seahedge Philippines Fund, has made a total return of 83%. It's the highest in the market. I'm not necessarily number one on any given year. 2012 was 18%, the market was 21%. The market is this, number 3. 2013, the market was 4%. That's when I was number 1, I did 15%. And year 2014, not necessarily number 1, 20%. This year to date is 10% up. So, I'm not necessarily beating the market every year. But as a whole, because my fund is probably less volatile and achieving a consistent return every year, that accumulates to a better performance over the long term. Yeah, I'm sad that my Union Bank large cap fund has somewhat fallen in performance. You have to do something different if you want to beat the market. Now, we're going to go through an exercise and try to see if we can spot a value stock. I've got 2 companies here. Let's look at them one by one. In terms of industry, both of them are consumer stocks, food industry. Company A has no recognizable brand. Company B has more than 17 recognizable brands. Company A does not sell directly to consumers. Company B sells directly to consumers. Nationwide distribution, none for Company A. Company B has one of the widest. Both have competent management. Let's look at their financial highlights. This is the last trailing 12 months as of September 2014. Revenue, Company A, 13.7 billion, 103 billion for Company B. Operating profit, 1.8 billion, roughly about 4 times for Company B. Net income, 1.6 billion versus 4 billion. Total assets, 11 billion versus 63 billion. And book value, 10 billion versus 33 billion. At first glance, it's very clear to see who the market leader is, correct?
Yes.
Which one is it? Company B?
Revenue, laki.
So would you expect that Company B obviously has a higher valuation, maybe a premium to the market, correct? Okay. Well, it turns out, actually not. Company B today is a more valuable company, or rather Company A is a more valuable company than Company B. Market cap of Company A, 65 billion, almost double that of Company B. Price to book, trailing 12 months, 6.8 times Company A, 1 time Company B. Are you guys familiar with these ratios? Enterprise value over EBITDA, 30 times for Company A, 4 times for Company B. You know what this means to me, enterprise value is the sum of the company's equity value plus the sum of all its debt. What it means to me is that Company A is going to take 30 years at its current pace before it can pay off all of that, versus only 4 years for Company B. Price-earnings ratio, very popular measure. Trailing 12 months, 31 for Company A, 12 for Company B. EPS growth, Company A has higher growth, 19% versus 14.3%. But remember what I said about PE to growth ratio, or the PEG ratio? PEG ratio, 1.7 times Company B. Company A. Company B, less than 1 time, 0.6. Forward price earnings ratio, 27 times company A, 9.5 times, under 10 for company B. Who's the popular stock here, guys? Company A is the popular stock, right? And it shows. Look at the daily average value turnover of company A. 77 million pesos per day. Company B, illiquid. Only 10 million pesos per day. Which is the value stock? A or B? Obvious, right? Anybody know which companies these are? Can you guess? Company A versus Company B. Company A, great company, D&L Industries. You know what these guys do? They manufacture food ingredients. And you know who their customer is? Company B, right? San Miguel Pure Foods. Who has a wider moat? For me, one of the best indicators of moat is brand. Who has a wider moat? San Miguel, Magnolia, Monterey, Star, Tender Juicy. Have you guys heard of these brands? Maybe you have. You're more sophisticated as investors. But I tell you, you speak to a man on the street, he knows Magnolia, but not Chemrez. Right? So, as you can see, you can find value in this market. And the only way that you can profit from it is by buying it. But that takes courage, right? It takes courage to go against the herd. To go against what your broker research friends or the research that your brokers are churning out. To buy it while it's unpopular. You know, Benjamin Graham once said, courage is the ultimate virtue in the market. You've got to exercise your conviction. All right. I'm going to ask you a question. Which would you buy? Let's say you had $1 billion to invest, 45 billion pesos. And you managed to convince management of both or the shareholders of both companies to sell to you for that price. Let me ask you a question. Would you buy D&L Industries? $1 billion is about a 37% discount to the current market cap of D&L Industries. So, would you be happy to earn that discount? Or would you buy San Miguel Pure Foods and pay a 30% or 33% premium to its current market price? Remember, guys, you've got to think like a business owner, not like an investor. Which would you rather own? The brand portfolios that San Miguel Pure Foods holds, or the business that D&L Industry offers? Right? To me, it's very clear what the answer is. I'd pay the premium. And in fact, even when I pay the premium, look at your margin of safety here. You know, one thing I've learned over the years is that companies can hit or miss their targets. Rarely do they exceed. But to hit, I would say 30% of the time. To miss, 50% of the time. And to do better, 20% of the time. Margin of safety, to me, means if you're going to miss, are you going to end up with a very expensive stock, or you're still going to end up with a pretty okay stock? For me, margin of safety is 16 times price earnings. So even if these guys miss their forward targets, maybe 16 becomes 20. But if these guys miss their targets, 27 becomes 30, 40. Margin of safety is very important when you're doing value investing. Well, that's kind of it for me today, but let me revisit one chart that I flashed in the beginning. You might wonder, what was in the portfolio, right? Back in the day when I managed it. Well, of course, they were the misunderstood, overlooked, and unpopular stocks of the day. And they went through that kind of similar process of misunderstanding, moving into recognition, and then finally re-rating. And in fact, in this particular portfolio that I held during that time, it culminated in a return of about 109% in 2010 alone. And it beat the market, which was 37% during that year. It was the #1 performer in Southeast Asia. What was in the portfolio? These guys used to be the unpopular stocks of the day. Universal Robina Corporation, Alliance Global, Union Bank, Aboitiz Power, Mega World, International Container Terminal Services. Those were my killer stocks in the day. And I held those stocks for a long time. Mega World, I've been holding since 2005. These are companies that went through that period. And so if you ask me, do I hold Pure Foods? Absolutely yes. And it's one of my conviction bets. Because I believe one day it's going to achieve this status. It's going to become popular. And when the market recognizes that, and they start to come in, and the flows start to come in, that's when you're laughing at the back, selling to them, and getting out. I want to thank you all for giving me this opportunity to...
Okay. We have a question. Right, I'll flash it on the screen. What exactly does illiquid stock mean?